Hi, everyone. Thanks for joining Jeff and I today on our webcast. We're going to get into Maple Leaf, but before we do that, Jeff, did you see in the news last week that the Cracker Barrel in the States, you know, that old the logo that has the man sitting on a barrel, they
Yep.
removed it. And the market reaction was it dropped 6%. So
hmm
there was a little bit of an issue there. The company revised it, reestablished the logo, and the market price went up 6%. So branding is important. Maple Leaf Foods has a brand. They're coming up with in the next few months a spin-off with Canada Packers. And Canada Packers is going to take over the pork business for Maple Leaf. So the branding with Maple Leaf Solid and the new company taking over the pork business spin-off should be, you know, substantial. So it'll create more flexibility for the company and all kinds of advancements. So we ended up buying Maple Leaf back in 2024. It was February for about $22.82. 18 months later, we're looking at a price hovering around 35.48. The dividend has never, I guess it hasn't dropped over quite a few years, and now it's around $1.36.
Well,
So
all in that,
all
all
in,
that's
all
yeah,
in, our clients have done a return of about 60%.
right. Yeah.
And it's one of our top performers, right? This
It's
year it's up. It is
the
the
top
top
performer.
performer. Okay, up nearly 80%. Huge.
Yeah.
So why don't you get into why we bought it?
Yeah, and first of all, I'm shocked that this is our best performing stock, but it just goes to show you that you should always be very hesitant to sell your stocks that you really believe in because you never
Yeah.
know when the market starts to notice. And we bought this stock, as you say, February 2024. It came on our radar because it had dropped about 10% in a day or two after they
Mhm.
reported a really dismal quarter. Their margins quarter over quarter had dropped, and analysts were really questioning the credibility of management's guidance that they were going to increase those margins. So we thought we'd have a look at it, and we came up after researching the stock with three reasons why we wanted to buy it. And why don't I
Mhm.
go through each of those three reasons?
Yeah.
Okay, one was I didn't agree with the analyst. I thought that management would deliver on their margin improvement.
Mhm.
They said that they can improve margins to between 14 and 16%. At the time, they were below 9%. So it was substantial improvement, but we thought they could do it. Second, the stock traded at a significant discount to peers like Hormel Foods and premium brands. And as you
Mhm.
said at the beginning, brands still matter. Okay?
Mhm.
If they didn't, a company like Cracker Barrel, who just all they did was change their logo, and they saw the
Right.
stock drop 6%. So brands
Mhm.
matter. And Maple Leaf Foods has Schneider's and Maple Leaf Foods itself. So those are well-known, recognized names, household names. And it was almost 40% cheaper than Hormel Foods, and I believe around 20% cheaper than premium brands. We thought that was too wide of a discount and it should narrow. So that was reason number two. And then
Mhm.
reason number three was that they had spent about $1 billion since 2017 to build two facilities, one in
Right.
Winnipeg and
Mhm.
one in London,
London.
Ontario.
Yeah.
And once that $1 billion was spent, we thought they could save about $130 million per year in expense reduction. And once that was
Mhm.
done, with the expense reduction, first they would reduce debt, and then once that's out of the way, they'll return capital to shareholders. So those were the
Mhm.
three reasons we wanted to buy it. Margin improvement, traded at a discount to peers, and expense savings. So here we
Right.
are 18 months later, and that thesis has pretty much come to fruition.
Yeah.
As of last quarter, their margins are in the 13% range, and that's up from about 11% year over year. So
Mhm.
management has followed through on improving margins. So that's reason number one has so far they get a check mark.
Hmm.
The discount to Hormel Foods and premium brands has narrowed, but it still exists. Okay.
Hmm.
It still trades at a discount to both those companies. And that's a reason for holding the stock or even buying it with new cash today, because we think it should trade at the same multiple as those two companies. And then lastly, the facilities that they built in London and in Winnipeg have saved them money and they've paid
Hmm.
down their debt. At its peak, it was about $1.8 billion dollars. Now it's $1.3 billion dollars.
Right.
And they've never cut the dividend, even during COVID. Good times and bad, they've maintained it and they've increased it every year. They recently increased it in January by 9%. And so we think they'll continue to increase the dividend. But in addition to that, once they spin off their pork business into Canada Packers in the next few
Hmm.
months, we think they will then use that cost savings to buy back stock. And that means fewer shares in the market, higher stock price. So we're holding it for two reasons. It's at a trades at a discount to peers. They haven't quite hit that 14 to 16% margin target,
Hmm. Hmm.
and we're waiting for that share buyback. So
Right.
it's still a buy. So we
Yeah.
like the stock, and hey, 80% year to date. I'll take it.
Right. Me too. Okay.
Yeah,
All right. Great to talk to you. Talk to you soon. Bye.
you too. Thanks, honey.